Welcome to Trends with Benefits, a podcast by Van Eck with a forward-looking perspective. We explore new ways of thinking about the markets, investing, work, and life. Here's your host, Ed Lopez.
So, Ed, what was that saying? Two Eds are better than one?
Sometimes.
I'm speaking with Ed Slott, CPA, and accomplished author of many financial and investment-related or retirement-focused books, including the most recently released, The New Retirement Savings Time Bomb, which we'll be talking about today. He also hosts the popular website IRAhelp.com as a resource for financial professionals and consumers, where the Slott Report blog is followed by tens of thousands of people. Ed, thank you very much for joining me today.
Great to be here. Important message for lots of people, especially with all the pending tax legislation. People are worried what to do. So much money in their retirement accounts. They see it bulging. Matter of fact, I'm hearing it's a problem. My IRA is getting too large, said no one ever. But that's what they're saying. They say, wait, what about the taxes on that?
Yeah. Well, so, my immediate question right now, and you probably can't answer this, is, how much money do I really need to quit this rat race and retire?
You know what? Everybody asks that question and nobody knows how to answer it. But the right answer is another question. How much do you need? Tell me how much you spend. That's how much you need. Done. That's how much you need for retirement. People have all these formulas. It comes back to basic math, like any budget. How much do you spend every month? What do you need for contingencies or emergencies? That's the number you need. That will tell you if you could retire early. I know there's that FIRE movement I've seen. The FIRE kind of died out the last year or so. But I think it stands for financial independence, retire early.
Yeah.
I see these isolated stories of people retiring at 30 and 40 years old. Not realistic. Even retiring today at age 60, given today's life expectancy, you could be having to fund a retirement for 30 or 40 more years. So I might tread lightly on that early retirement stuff.
I'll have to keep that in mind. In fact, that was going to be one of my trend or fad questions for you, was the FIRE movement. And I think you pretty much answered that one.
I think it got watered down, that FIRE stuff. And you do see those isolated stories, but they're extreme. People, that haven't eaten in 3 years and they saved all this money and, it's like frugal on steroids or something. And still, though, you have to fund. Remember, the earlier you retire, the more years you have to fund with money.
Yeah, that's an important ingredient there. So the name of your book is compelling, but what is the New Retirement Savings Time Bomb? What do you mean by that?
Remember the old Who song, Meet the New Boss, right? Same as the old boss or something like that. Meet the new retirement savings time bomb, same as the old retirement savings time bomb, but only worse. The time bomb, or what I like to call the ticking tax time bomb, say that 3 times fast, is the taxes building up in your retirement savings, your tax deferred retirement savings like your IRA and 401k. And the larger those accounts get, the more tax will be owed. So most people don't think about it, but every day that you do nothing, you have a growing, building, compounding debt in your IRA. Because remember, it's only tax deferred, not tax free. Those funds have not yet been taxed, but they will at some future date, maybe at a higher balance if things keep growing, and maybe even at a higher tax rate, depending on what the tax laws will be, just when you need the money the most, in retirement, when the paychecks stop, when you're the most vulnerable, when you may not have other sources of income. So it pays to do something about it now. I always say to audiences, do you want your plan or the government plan? And obviously you want your plan. Now, sometimes people ask me, Ed, what do you mean by the government plan? Oh, that's easy. Doing absolutely nothing and letting it happen to you. So right now, Ed, we see people kind of happy with the stock market going up and up. Their IRAs are going up. But again, it's a growing, building debt. a lot of that money is not owned by you, but instead owed to IRS at some point. So that's what I call the new retirement savings time bomb. There are new and even more severe threats to your retirement savings now for two reasons. One, I just said, the balances are getting larger, but the other reason is it's not uncommon. In fact, for many people, their IRA or 401k is now their largest single asset, larger than the value of their home, and it's loaded with tax. So I'm sure, Ed, when you talk about investments, you always tell people the old adage, don't put all your eggs in one basket. Well, that's what a lot of people are doing. They have all their eggs in one big bag of tax. That's a lot of eggs that can be broken at some point later on.
Yeah, a lot of people think that they're investing in these deferred programs or products, and with the idea that they're going to be in a lower tax bracket when they retire. Is that a mistake to think that way?
I think that's a myth. Lots of people think that because that's what they've always been told. That was what we were told and sold years ago. We made this deal with the devil, so to speak. You get these tax deductions up front when you put the money in your 401k or your IRA, but you'll take it out in retirement when you'll be in a lower tax bracket. That wasn't even true for the last few years or so. I remember having clients over many years, they built, worked, saved, and all of a sudden they had this large IRA or actually large 401k, which they eventually rolled over to their IRA. And then they retired. And when I was doing their tax returns, a lot of people were shocked to see that their income in retirement was higher than their best working years. And they would say, how is that even possible? I don't even have wages. And neither does my spouse. Well, look at your IRA. Remember that deal with the devil? Well, basically, that deal says there comes a point, and the government sets that date, when you have payback time. That's in essence what the tax rules say. We're sick and tired of waiting for you to drop dead, and we want our money back. That's called your required beginning date, which now starts at age 72. So at that point, this money is forced out, and the larger your IRA, the more that has to come out each year, and that's all pure taxable income. In another way, too, many people miss out. They think they'll be in a lower bracket. This is for married couples. I call this the widow's penalty. When the first spouse dies, there's an issue. Together, they're thinking we'll be, even if they actually are in a lower bracket, they think that's going to continue forever. But the odds are, and I'm, no predictor, but with any married couple, one spouse is going to die first. I'll put odds on that. One spouse is going to die first. At that point, the surviving spouse, let's say it's the wife, at that point, since most people leave everything to their spouse, that spouse, the wife in this example, will have all the assets they both had together. And her income, other than maybe some adjustment in the Social Security check, will be the same income they had together. But now she's filing as a single individual. And that's when she's going to see her tax rate skyrocket. So I call that the widow's penalty for people who think that they will be in a lower bracket in retirement. It may not be the case. And then we have the Secure Act, the tax act that happened a couple of years ago, which eliminated the long deferral of distributions to beneficiaries, commonly known as the stretch IRA, the ability for children and grandchildren to inherit and defer that tax, taking only minor distributions for 60, 70, even 80 years in some cases, depending on the age of the beneficiary. That's out now for most non-spouse beneficiaries. Most of them will have to cash out under the 10-year rule by the end of the 10th year after death. So that could bunch a lot of that tax into 10 years after death, where the beneficiaries who may be in their 50s by that point, may be in their own highest earning years. So if you look at the taxes, you have to look at the taxes not only in retirement, but right through to your beneficiaries. This is all about the tax rates. All of this planning is a giant tax rate arbitrage, you might call it. The foundational principle in all good tax planning is to always pay taxes at the lowest rates. Now that sounds simple. It's kind of like with a stock. Buy low and sell high. Now, I didn't make that one up, but that's a good rule too. Buy low and sell high. It reminds me, and I quote this in my book, the old comedian. I don't know if you remember him, Ed. You might be too young for that, but Henny Youngman. He was famous for these one-liners. But one of the best ones, I think he had it in the 50s or the 60s, was this one line about taxes. And it was so brilliant. It was funny, but brilliant. He said, I'm putting all my money in taxes, the only thing sure to go up. He was right. That's what you have to do here. To buy back the taxes. Remember, I told you about this big growing debt in your IRA. This is something, it's not if, but when. This is something that will have to be paid. So you can arrange your planning to pay it at the lowest possible rate. That will leave you more of your money to enjoy now, more for retirement, more for your loved ones. And in many cases, it can be more of it tax-free if you do the planning now. And that's the secret to this book of mine, The New Retirement Savings Time Bomb. Yes, the title is the problem, but the book is the solution.
So what more about the solution can you highlight? I mean, you talked about the IRA. You spent a lot of time talking about IRAs and rolling over to IRAs, but are you also talking about diversifying into other types of structures to help people plan for this tax potential?
The ticking tax time bomb for detonation at the worst possible time. Yes, that's coming. First of all, you have to look at what's going on in Congress and in our nation's numbers. I'm talking about the debt and the deficit. I mean, it's off the charts. These are bills that will have to be paid. Who will pay them? Taxpayers. Which taxpayers? The taxpayers with the highest taxable income. That brings everybody with an IRA or 401k into the soup because, again, that money, you can never forget this, has not yet been taxed. And it's at the mercy, or you might call it the uncertainty, of future higher taxes. That's not a good situation. So one of the things I say, or I've been saying for 20 years, probably more than that, I always say to audiences, you want to move your money from accounts that are forever taxed to accounts that are never taxed. Forever tax to never tax. Forever tax is the tax deferred where most people have their money, the IRAs and 401ks. Never tax is tax-free vehicles. So you want to start making the shift from forever tax to never tax. So there's a couple of ways to do it. I actually spend a few chapters on that, but I'll give you that. One of the best and simplest ways to move from forever tax to never tax is through Roth IRAs, Roth IRA conversions. Now, it sounds good. People might be on here saying, well, that's great. Let me just move my IRA to a Roth. Well, there is a little catch. You have to pay the taxes to move the money. And that is the secret to having more, keeping it, and making it last. Remember, when you're doing planning, you plan for the score at the end of the game. You don't focus on what it's going to cost you now. You focus on what you'll get for your money later on when it means the most in retirement and the transition to your spouse or other heirs, your children and grandchildren. You have to look at the long-term big picture. It's the same thing with retirement. So with the Roth, yes, you do have to pay taxes up front. But if you can get that money out at the lowest possible rate, which might be right now in 2021, then you're getting something for your money. You're getting tax freedom. You're getting relieved of a debt that could be much larger and take a bigger toll on you when you need the money most in retirement. So that's the secret to really parlaying your IRA into a tax-free fortune. The reason most people don't take advantage of it is because they only focus on what does it cost me now? Why on earth would I ever pay a tax up front when I could delay it for years, even decades? Yes, you can delay it, but who wants the big bill in retirement when rates might be up to 40, 50% for you and your money's only worth half as much? Get rid of that debt. Start paying down that debt. Pay the taxes up front. That's the secret. But it's counterintuitive because when I mention this to people, I tell them, I'm going to give you the secret to have more, keep more, and make it last and have more of it tax-free. Oh, yeah, what's the secret? Pay taxes now. What? What kind of secret is that? Why would I pay taxes voluntarily up front to have more later? The strategies I'm talking about, one is a Roth IRA. There are others we can get into. Will leave people with savings, real tangible savings and taxes saved. Remember, every dollar you save in taxes, that's more money you can enjoy in retirement or pass on to beneficiaries. But the minute you do this, for example, do a Roth conversion, the minute you're free of that debt, then every dollar of growth grows 100% for you. 100%. You keep 100% of your money. The money that can be saved, depending on how much you have in your IRA, can be tens of thousands, hundreds of thousands, or millions more than you would have had by just doing nothing. So that's the whole theme and the secret of the book. But one way is through Roth conversions.
During that Roth conversion, does the age matter? I mean, does it make more sense if you're a little younger or a little bit before retirement, or does it make more sense then versus when you're a little bit older?
All right, let's go back to the younger people. This is a slam dunk. Every young person should only be doing Roth IRAs or contributing to Roth IRAs at work, Roth 401ks, if your company has that in the 401k or 403b plan. Not everyone has it, but more of the companies are coming around. See if you can switch over to the Roth 401k option. Start building your money tax-free. Don't do 401ks at work anymore. So what? You get a tax deduction. It's just a debt you have to repay sometime later. Why not enjoy, get rid of that tax deduction? Yes, you'll pay some more up front, but look at the growth. We'll be growing all 100% for you for the rest of your life. So that advice is pretty good for new workers, 20s, 30s, 40s, even into your 50s. Now, as you get older, you might say, well, should I convert? Like people ask me that all the time in their 70s or 80s. Should I convert? Well, it depends what the plan is, the end game for your IRA. If it's only for you, then the upfront cost of converting, given, sorry to say, as you get older, less of a life expectancy, the tax cost of converting may not be worth the benefit you'll receive in your shorter life expectancy. But I've had clients over the years that converted at an older age because they were doing it for their grandchildren when there was such a thing as a stretch IRA. And even now, some people are doing that. Say, look, I want my children to inherit tax-free money. I'd rather pay the tax now. Paying the tax now reduces the value of their estate and maybe can lessen exposure to estate tax. Remember, all IRAs are included in the estate, Roth IRAs too. So that could be a way to reduce your estate and at the same time pass on tax-free money to your children or grandchildren, even if they have to take it out under the Secure Act's 10-year rule.
Are there other planning tools that you think people overlook and should consider?
Yes, I mentioned, I have 5 steps in my book on how to go through this process of moving from forever tax to never tax, to make sure you don't mess up any of these complex IRA rules. This is the problem, really. I explain it in English in here, which is no easy task, I have to tell you. These rules are complex. The rules of getting money out of an IRA, a 401k, and required minimum distributions and inherited RMDs and trusts as beneficiaries, very complicated. They're among the most complex tax laws in the code. But the thing that really hurts is in many parts, in most of this area, these rules are not only complex, but often rigid and unforgiving. You don't get a lot of second chances. For example, I mentioned Roth conversions. I wouldn't jump on the Roth conversion train right away without speaking to a financial advisor or your tax advisor, because once you convert, it's permanent. There's no going back. There's no do-overs, no second chances. So you only have one chance to get it right. So for consumers, you should only work with financial advisors or tax advisors that are well versed in these rules. Unfortunately, most are not. Most financial advisors are good at helping you make money, but this is about keeping it, getting that money. When it comes to IRA or 401k money, it's not how much you accumulate, it's how much of that you get to keep after taxes, because you can only spend what you keep. So you have to have an advisor that's well versed, not only in the investments. I think most advisors can help you make money. It's about keeping it. The whole end of the game, the whole plan here is to have more. I keep saying this, but this is what it's about. Have more, keep more of what you earned and more of it tax free, and make it last. Obviously, the less you pay in taxes, the more you get to keep. I have a plan, a nice, easy one, a 5-step plan. That's what the new Retirement Savings Time Bomb book is about. It's great for advisors and consumers. But I already gave you the secret. I told you about Roths as one way to move from forever tax to never tax. I'll give you another way. I'll give the whole book away because I want you to take advantage of this. Another way to do it, which may surprise people, is with life insurance. Now, just so you know, I'm a CPA, a tax advisor. I do not sell life insurance. I don't sell stocks, bonds, funds, insurance, annuities, none of that stuff. I'm a tax advisor. So that's another benefit of the book. You can get an independent, objective, unbiased opinion. But as a tax advisor, I have to tell you, among the single biggest benefits in the tax code is the tax exemption for life insurance. And I'm talking about permanent cash value life insurance, not term insurance. And it's not used nearly enough. It's almost like a super Roth IRA. And what Congress did with the Secure Act, eliminating the stretch IRA, made both Roth IRAs, which become tax-free, and life insurance tax-free, much more valuable. To me, now they go to the top of the list. They've been given an upgrade by Congress indirectly, and the IRAs and tax-deferred accounts that are growing at some future rate have been downgraded. That's exactly what Congress attempted to do. In 40 years of studying tax law, I've noticed one constant. Whenever Congress names a new tax law, you can almost always bet that whatever name they give it, it will do exactly the opposite. So when I saw something called the Secure Act, I'm thinking, hold on to your wallets, it's coming. And sure enough, they took away the stretch IRA. But they also opened up opportunities. I think Congress shot themselves in the foot because now people are more incentivized probably to do the better planning they should have been doing all along, moving to tax-free territory. So you could take down the IRA at today's low rates, pay the tax, and put it into a life insurance policy that can grow for your beneficiaries without all these complex RMD tax rules and 10-year rules. You could even use trusts if you're worried about beneficiaries who may need some hand-holding or control vehicles so they don't become spendthrifts and blow the money. Insurance is the most flexible asset for that. Plus, many of these policies have cash value that you can use as a tax-free retirement vehicle during your lifetime. So this is an option to use where the result is larger inheritances for your family, more control, and less tax. If that's what you want, change the vehicle. The point here, and I make that point in the book several times, you know those books, Ed, that I forget what it is, but it's a theme like what got you here won't get you there. You've probably seen those books. So what got you here is the growth in that IRA. That's the vehicle that got you here. But thanks to Congress, that vehicle is now an old jalopy and it has pooped out at death. It's no longer a good wealth transfer vehicle. Congress did that purposely. They felt in the Secure Act, they said, look, IRAs, 401ks, they should be for your retirement, not to pass on to beneficiaries, not for estate planning, not for wealth transfer. So we're going to make it a bad asset for that, which they did. So this IRA jalopy poops out. So you're not married, and it's not sacred married to that vehicle. Change vehicles. Get rid of that old IRA jalopy. And then, for example, with life insurance, move to a limousine. a life insurance limousine, a luxury life insurance limousine for the rest of the ride. Providing, again, you can have a plan. I show you how to do it. In fact, I have a whole chapter on life insurance. I call it the power of life insurance from somebody who's a tax guy, not a life insurance guy, because I look at the benefits. If you can have more of it and more tax-free, you're in better shape at the end of the game. Larger inheritances, more control, and less tax. That should be the plan. The vehicle that gets you there is of little significance. You just want results. You don't care what vehicle. It's just that people got this thing that the IRA is supposed to be for my retirement. Well, Congress says, it can be for your retirement, but after that, we're going to cut it to shreds if you don't do something.
So how do people use life insurance during their retirement? In terms of like actually taking cash out for their own use? Is it a loan?
You could do that. You'd have to speak to your insurance professional and financial advisors. I am not an insurance professional, but it can be set up. I have this myself where you have cash value, which can be taken out if you needed it during retirement. Imagine if rates go up to 40, 50%, depending on your income, like they're talking now, maybe higher. What everybody should be looking at in an environment of rising tax rates is to have more tax-free vehicles to tap, like Roth IRAs and life insurance. When tax rates increase, anything tax-free becomes immediately more valuable, like life insurance. So you're building up cash in this life insurance, say you need money. It turns out most people don't need to tap into it. But if you did, you could tax-free. People like when I say that in seminars. They say, you mean I can use it during your life? I say, yeah. As a matter of fact, I throw out this question because it throws people off. They say, wait, I thought life insurance is only after death. That's why most people, when I mention life insurance in programs, they give me that look like, what's in it for me? I just pay everybody and then I drop dead. What's in it for me? And I said, well, there are lifetime benefits. And then I'll ask them this question. Can you be the beneficiary of your own life insurance without dying? And the answer is yes, by having access to the accumulation if you need it, and tax-free, like with Roth IRAs, tax-free. That's the key. But some people like it so much, they say, well, I like that. And then they'll hit me with the follow-up question. They'll say, wait a minute, if I take some of the benefits out there in my life, won't my beneficiaries get less? And I look at them, I said, well, who cares about them? This is about you. You got to take care of yourself first. They're going to get plenty. That's the big problem. You worry too much about your kids and grandkids. They're going to get plenty. It's going to be the greatest wealth transfer people have ever seen. They'll get plenty. They'll just get a little less, and you'll have the peace of mind knowing you have it to use if you need it. If it turns out you don't need it, yes, they get a giant tax-free windfall. That can only be done with the leverage of life insurance. That's where I say it's like a super Roth IRA. You can provide larger inheritances, more control, and less tax. But again, even the two strategies I gave you to move from forever tax to never tax involve paying some tax now to free up that debt growing in your IRA. That's the secret. Get rid of the mindset that I'll be out that money up front. No, you'll have more later on and more for your loved ones and more of it tax-free.
Let's talk about some other strategies, because right now real estate is one of the hottest markets. And for years, I've been hearing about people putting real estate in their IRAs. What are your thoughts about that and other alternative investments, maybe nudging the growth, hopefully, in their IRAs with such types of alternatives?
I would be very leery. Normally, I advise against it unless you're some kind of real estate or alternative investment professional. Like anything else, you have to know what you're investing in. Yes, you can invest in these things in your IRA, but remember, then you're on your own. You can't go to the regular bank, broker, or fund company and say, that lot over there on, I-95 or whatever, put that in my IRA. And they'll look at you like you have four heads. Really? We do stocks, bonds, and funds. We don't do real estate. We don't do other limited partnerships, alternative investments, gold, all this other stuff. You want that, you have to go to a self-directed IRA custodian. They will house these exotic type investments or non-traditional investments. But they're not the police. They will house it for you. but you're still going to have to abide by the rules. And the rules are pretty harsh. You could have a prohibited transaction if you use it personally. Remember, the funds have to be, take example, real estate. Unless you really know real estate, actually, if you do, the best place for it would be a Roth IRA, not an IRA, because if you put real estate in an IRA and you bought the real estate because you think it's going to skyrocket, well, then we're back to the same problem. It's skyrocketing, but part for the government, for IRS. Remember the point of the book. You don't want to share with Uncle Sam. And you know why? He's not even your real uncle, okay? You don't have to share any of the money. But if you had real estate in an IRA, you would be sharing in the appreciation. With a Roth IRA, it would come out totally tax-free. But you have to be careful and play by the rules. You'll need annual valuations for distributions. You also can't use it personally. The self-dealing rules, that's what kills a lot of these alternative investments. The self-dealing rules can relate to prohibited transactions. Let me give you a simple one. You buy a lot and a house maybe because you think it's a good investment and you have money in your IRA to buy it with, and you buy it. And you don't want debt because you can't have debt in your IRA. You can't borrow in your IRA. So you'll have to have like a non-recourse loan or have the cash to finance it. That's a problem too. Let's say you do have the cash, you have $1 million in your IRA, you see this nice little house and a lot or something for a few $100,000, maybe 500,000, whatever, and you buy it. And then you decide, I love this little house. Let's move there. Now that's a prohibited transaction because you used your IRA assets personally. Now the whole account becomes taxable. The minute you self-deal, that's what's called self-dealing, you use it personally. Matter of fact, I have a whole chapter on real estate in your IRA. In the back of the book, under a section, what to do when stuff happens. And that's where all the dangerous stuff is, where you could lose your whole IRA to a prohibited transaction, not even knowing you were doing anything wrong. And plus, when it comes time for required minimum distributions, you're going to need valuations. You're going to need other cash in there. You don't want to eat up all your cash to take the RMDs, because if you have nothing but property in there, you're going to have to deed out like 1/27th or 1/26th of the property each year to yourself to satisfy the RMD rules, and you'll need a valuation. IRS asks for special reporting on that. So unless you really know what you're doing, I would stay away from it unless you are truly a real estate professional or have knowledge in any of these other non-traditional investments. And then even then, I would push them more towards the Roth IRA, so the growth would be tax-free.
So, I really appreciated your book because you gave a lot of great examples and a lot of detail and made it easy to read as far as tax reading goes.
And it's kind of fun too.
Yeah.
For a tax book.
Absolutely. And then you wrote that 1% of advisors are really competent to do this distribution type of planning.
Did I say 1% in the book? I think I did.
Yeah.
Yeah, so people always ask me, Ed, what are you saying? Only 1% of advisors know all about these distribution and tax rules? And I said, no, it's much less. I rounded up. I was being a good guy. I rounded up. But it's true. They're just not trained in that area. They're trained to help people make money. But again, back to the theme, if you make money, your account grows in a tax-deferred account, you'll be sharing it with the government unless you have a plan to disarm that ticking tax time bomb.
And do you work with advisors now?
We train advisors that have specialized knowledge. We put on the extensive 2-day, well, now they're all virtual. We used to travel all over the country. And we'll be back doing that, I believe, in October. But for advisors watching or listening, we have our 2-day virtual program. That's 2 solid days. We go through a 400-page virtual manual, which you get to keep as a reference guide, covering everything you can imagine. All these things we talked about, some things we didn't talk about, like one of the biggest decisions. That's what I opened the book with. The first chapter is called What to Do with the Biggest Check of Your Life. You have money sitting in a 401k or an IRA that could be a life saving. Should I roll it to an IRA? Should I keep it in the plan? Should I convert to a Roth? Should I do a lump sum distribution? So we have a whole section on that. We have a whole section on trusts as beneficiaries, a whole section on things we talked about here, Roth IRAs, life insurance. So we go through these 400 technical pages in 2 days while we're answering questions live in real time. So that's an amazing program. Every advisor that really wants to help their clients should have a basic knowledge like that. There's a lot there. What most advisors say when they go through that program, usually within the first 2 hours, they'll say, I didn't realize how much I didn't know. I didn't know how much I didn't know. Well, that's the beginning of knowledge. Now, that's just our basic program. Once you go through that, if you want to still learn more, and we have plenty of advisors that do, they qualify to join what's called Ed Slott's Elite IRA Advisor Group. And we have levels of that. Our elite level, to get into that, you have to qualify by going to the 2-day basic training, kind of like the Army, I guess. The basic training, then we go to the elite level. And then after 2 years of that, you can go to our highest level, the master's level. And you can find out all about that on our website if you're an advisor looking to do a great job for your clients. It's a real differentiator, especially when investing has become somewhat commoditized with everybody charging, I don't know, zero. It's becoming commoditized. So you have to help clients keep more of their hard-earned money. That's where the value is. That's where I've done my whole practice like that. I've discovered the magic words in the 60s. If you remember the movie The Graduate, what was the future in the 60s? The one word, do you remember that?
No.
Plastics, remember?
Ah.
Right, I'm telling you, he tells the young Dustin Hoffman, plastics. Well, I'm telling you now, and I realized this years ago, it's 2 words. Wealth transfer, helping people keep more of their hard-earned money in transition when you're going from a job to retirement or going from your life to your beneficiary's life and to grandchildren. Wealth transfer, estate planning, saving clients hundreds of thousands, if not millions, in taxes and actual money that you can save. That's where the high value is. That's the way to differentiate yourself from most other less informed advisors. And for consumers are learning so much because they realize as they see their IRA balances going up, they need to work with an advisor that has this knowledge. And we see a lot of consumers actually moving from advisors they liked. For 30 years, I had a great relationship, but they realized the advisor that got me here isn't the same advisor that's going to take me the rest of the way. Now I need a specialist, somebody that has specialized knowledge and skills in helping me keep more of my money and pass it on to my loved ones at the lowest possible tax cost. And that's what we do in our advisor training. And we show consumers how to do it in consumer programs we do, and in this book of mine. So there's lots of ways to get this knowledge, but there's no question that you can create a plan immediately starting now to keep more of your hard-earned money protected from the taxes that are here now and the big taxes that I fear are yet to come.
So since we're a podcast about trends, one question I ask guests are, what is one long-term trend you see playing out over the next year or several years?
I see people no longer going to 401ks, everything Roth. Everything's going to be Roth 401ks. Everything's going to be Roth IRAs. And this is a huge benefit to people. Like I said, you're building tax-free. But you know who else wants full Roths? The government, Congress. They've been in the last few tax bills and in the budgets that several presidents, back to, I think, even before Obama, but Trump, they all had it in their budgets. The concept they were calling Rothification. Have you heard that word, Ed?
No, I haven't heard that word.
It was in all the policy proposals. In fact, it's in the big tax bill being negotiated now. Full Rothification. Why do you think the government wants that?
They want their money now.
Because they're short-sighted. They're short-sighted, so take advantage of their financial ignorance. They believe if everybody goes Roth, that people no longer get tax deductions for their contributions to retirement accounts, so they'll get more tax money. Yeah, up front. But if everybody did that, everybody would be Roth IRA millionaires that would never pay taxes again. So take advantage of their short-sightedness. They are pushing, it's in the tax bill being negotiated now. They want to bump up the ability to do more in Roth 401ks, more catch-up contributions, more indexing. everything, pushing more money into Roth because they believe that will create revenue for the government by the loss of tax deductions. I'm saying, yeah, that may be true in the short run, but in the long run, I would take advantage of that and start moving to Roth IRAs and building 100%, all of that money accumulated 100% for you without sharing.
So we do a speed round at the end of our segment called Trend or Fad, where I ask you a couple different concepts and get your quick take. We already talked about one of them that I had planned, the FIRE movement, which is probably a fad.
Fad.
Yeah. All right. One other one, cryptocurrency, trend or fad?
I don't know. I don't know enough about it. To me, if you ask me, it just looks like a giant Ponzi scheme.
Connected home fitness, trend or fad?
It's probably a trend. I know my kids who are millennials, they love that stuff, talking on, you know what, that's not for me. I do all my exercise walking on real streets and real blocks.
Yeah, I like to take it outside myself as well. So one other little trend that has happened recently, pet adoption or pandemic puppies.
I don't know anything about it. I'm the wrong guy to ask.
I keep thinking about, I see everybody, in my building in New York with dogs, and, you walk outside and my exercise, you go outside and you have to sidestep a bunch of poo, if you will. So everybody's got a pet these days, it seems.
That I will tell you, in all my walks, I'm always looking down. And I tend to walk very early in the morning, and everybody's out with their dogs. So it makes them feel good. All more power to them. Anything that makes people feel better about themselves is all good.
Amen to that. Well, Ed, this was fantastic. Thank you very much for your time. Again, what's a good way for people to find you and connect with you?
Oh, you go right to our website. Very easy. IRAhelp.com. IRAHELP. IRAhelp.com. And if you want to email me, if you have any thoughts on what I said, I'll even give you my personal email. I love sharing my gospel with you. I want you to have more, keep more, and make it last. You can always email me with any comments about things. I'll give you one thing that I know people will want to ask. Ed, you talk all about the Roth. This is the one question I get in every seminar. They always ask, Ed, you talk about the Roth, but can I really trust the government to keep their word that Roths will always be tax-free? Absolutely not. You can't trust them as far as you can throw them. Look what they did in the Secure Act. My personal email, I think I started saying, is very easy. Ed, E-D, at IRAhelp.com, the same website, ed at IRAhelp.com. Be happy to hear from you and tell you more if you want to know about our books or programs, or you have questions on some of the items. We covered a lot of material, Ed. People say when they listen to me on a program like that, it's like drinking from a fire hose. So if you felt you got overly sprayed and you have questions, happy to hear from you.
And definitely pick up the book. There's a lot more info in there. Again, Ed, I appreciate your time.
Yeah, thanks for having me on. Thanks to the folks at Van Eck.
And thank you for tuning in to another episode of Trends with Benefits.